Welcome to the deep dive. Today we're tackling a really interesting one, IREN Limited, ticker IREN. We're asking if this could be the ultimate pick and shovel play, a way to invest in both Bitcoin infrastructure and the AI revolution through just one company.
And it's got this compelling angle, doesn't it?
Hmm.
Massive scale, vertical integration, and maybe most importantly, it's all powered by 100% green energy.
Exactly. But there's a catch, right?
There always is.
Yeah.
Right now, as of October 23rd, 2025, the stock's at $53.50. Our own analysis puts its intrinsic value somewhere between, say, $40 and $65 a share. So it's trading right in the middle, maybe even a bit high in that range.
Which means the market is pricing in a lot of success already.
A huge amount. We're talking a trailing PE over 150. Basically, the whole investment hinges on management flawlessly executing this massive pivot into AI cloud services. Perfection is priced in.
Okay, so that's our mission for this deep dive. Using the source material from October 23rd, 2025, can we figure out if IREN's competitive advantages justify that optimism, or is the execution risk just too high in this price?
That's the goal. Let's see if the numbers in this strategy hold up.
Before we jump in, a quick reminder. Like and subscribe to Stock Analytics AI. For just $4.99 a month, you get access to our full library. That's 500 deep dives covering the S&P 500.
And we're adding the NASDAQ 100 next, exclusively for members. Plus, members can request deep dives. Just drop a ticker in the comments.
All right, let's get started. Chapter 1, Business Analysis.
Okay.
So let's unpack this dual engine model everyone talks about with IREN. It seems key to understanding their current identity.
Right. Engine 1 is the foundation, the original business. Bitcoin mining. It's definitely the more volatile part, but it's still performing strongly. Fiscal year 2025 saw record revenue of $501 million.
Wow, that's a 168% increase. So the mining operations themselves are running well?
Yeah, operationally, they seem solid there. But Engine 2, that's where the real excitement and, frankly, that high valuation comes from. That's AI cloud services.
The diversification play.
Exactly. It's still pretty new, nascent even, but it saw a 33% revenue jump just in the third quarter of FY25. And management isn't messing around here. They've set a really ambitious target.
That she is.
They're aiming for a $500 million annualized revenue run rate just from AI by the first quarter of 2026. That's incredibly fast growth they're projecting.
So the idea is to balance out the Bitcoin volatility with more stable, recurring AI revenue.
Precisely. AI contracts tend to be multi-year deals, much more predictable. It shifts IREN towards being, a more resilient tech infrastructure company. They call it becoming a neo-cloud provider.
Okay, neo-cloud. We hear that term a lot now. Can you break that down a bit? How is it different from, say, AWS or Azure?
Good question. Think of it like this. Traditional cloud is like a general department store. They offer storage, basic compute, bit of everything. A neo-cloud, like what IREN is building, is more like a specialized high-performance workshop.
Focused just on the heavy lifting.
Right. Focused solely on high-density specialized compute. We're talking racks packed tight with the latest NVIDIA GPUs, like the H100s and H200s, designed specifically for really power-hungry tasks, like training large AI models. Their core isn't storage, it's delivering maximum computing power per square foot efficiently.
And that power focus leads straight into their main advantage, their moat.
It does. Their whole value proposition centers on providing this high-density compute using 100% renewable energy at some of the lowest electricity costs you'll find anywhere.
What kind of costs are we talking?
The average is around 0.033 tons per kilowatt hour. And down in Childress, Texas, it gets as low as 0.028 tenses. That is a significant, potentially durable cost advantage over competitors.
Especially when energy is such a huge input cost for both mining and AI.
Absolutely critical. And they lock that advantage in through vertical integration. They own the land, they build the power infrastructure, they run the data centers. That control is huge.
So their key asset isn't even the GPUs necessarily, it's the power itself.
You could argue that. The source material calls it their power bank. They've secured grid connections for a staggering 2,910 megawatts of total capacity, with 810 milliBU already operational. In a world increasingly hungry for power, that secured capacity is like gold.
2.9 gigawatts. That's enormous scale. And they're filling that capacity fast with AI hardware too, right?
They are. They're scaling the AI fleet rapidly. The plan was to hit around 23,000 GPUs by September 2025, including those top-tier NVIDIA H100s and H200s.
It's interesting you mentioned the scarcity of power. Sources also talk about regulatory risks, like British Columbia maybe restricting new crypto miners connecting to the grid. That sounds bad initially.
It does, but there's a paradox here. For IREN, this kind of regulatory risk almost becomes part of their moat.
How so?
Well, if regulators make it harder for new players to get grid connections for energy-intensive operations like mining or AI, it just makes IREN's existing, secured 2.91 gigawatts of power, even more valuable and harder to replicate. It locks out potential competitors.
Ah, okay. So barriers to entry for others actually strengthen IREN's position because they're already inside the gate with the power secured.
Exactly. It enhances the strategic value of what they already control.
Chapter 2, Management Evaluation.
Let's look at the leadership.
So the company was founded back in 2018 by co-CEOs Daniel and Will Roberts, who are brothers, and they've been tested, particularly during that brutal crypto winter in 2022.
They definitely have. The stock dropped, what, 96%? There were disputes with creditors.
Yeah.
Just surviving that period shows a certain level of resilience and crisis management capability.
And beyond just surviving, the sources credit them with strategic foresight.
Yes, specifically the pivot to AI infrastructure in 2023 and 2024. They recognized that their core skill building and running these power-dense data centers was directly applicable to this booming AI compute market, the neocloud space. That was a crucial, timely shift.
They also weathered that short seller report from Culper Research in mid-2024, didn't they? The market seemed to shrug it off eventually.
It did seem to discount the claims, yeah, which suggests the market, or at least a significant part of it, maintained confidence in the management team's narrative and execution.
Okay, but we have to talk about the insider selling in September 2025. The co-CEOs each sold 1 million shares. That's $66 million combined. Taking that much money off the table right when the AI hype is peaking, that doesn't look great, does it?
It's a point you absolutely have to consider. 66 million is a lot of money. The counterargument in the source material, though, emphasizes context,
It is.
that it was actually a relatively small fraction of their total holdings. They each still own over 5% of the company, so they still have hundreds of millions of dollars tied directly to IREN's success.
The argument is that it's significant personal diversification, but their fundamental financial alignment with shareholders remains very strong.
Okay. Still, the timing is notable.
It is. It warrants scrutiny, no question. But it doesn't necessarily negate the alignment argument, given the scale of their remaining holdings.
And their overall capital allocation strategy lines up with this growth story completely. It's all about aggressive organic growth. You see it in things like that huge $674 million GPU procurement deal. There are no dividends, no share buybacks. Every spare dollar is being plowed back into building out capacity.
Which brings us to the return on invested capital, the ROIC. It's currently pretty low, right? Around 5.25% on a trailing 12-month basis.
Yeah, it is low. And this is really important for listeners to understand. That low ROIC figure is almost certainly a lagging indicator, meaning the invested capital part of that ratio, the denominator, has ballooned recently because of all the money spent on new data centers, new power infrastructure, those expensive GPUs.
Right.
But those assets aren't fully operational and generating revenue yet.
So the investment has been made, but the returns haven't shown up in the numbers yet.
Exactly. Once those assets, especially the AI cloud infrastructure, come online and start hitting those revenue targets like that $500 million run rate, you'd expect the ROIC calculation to look dramatically better. The current low number reflects the investment phase, not necessarily the long-term profitability potential.
Chapter 3, Financial Analysis.
Okay, let's connect operations to the financials.
Right. So IREN's now firmly a large cap stock, market cap around $15 billion as of the source date. And that's driven by truly explosive revenue growth, like that 168% jump in FY 2025 we mentioned.
The top-line growth is undeniable, but the margins tell a more complex, maybe even confusing story.
How so?
Well, the gross margin is actually very healthy, 68.3%. That shows the core business of providing powered infrastructure is profitable. They make money on the basic operation, but the operating margin drops way down to just 4.1%. That's because the selling, general, and administrative expenses, the SG&A costs, are really high right now. That reflects the cost of scaling up so rapidly, building out the teams, the sales function, managing this global expansion.
Okay, so profitable at the core, but the expansion costs are eating heavily into operating profit for now. Yet the net margin reported is much higher, 17.4%.
Yeah.
Seems odd. How does net income end up so much higher than operating income?
Yeah, that 17.4% net margin needs a big asterisk next to it. It's not really reflective of sustainable core profitability.
Why not?
Because it was significantly boosted in FY 2025 by a large one-off non-operating income item, about $91.2 million. If you're trying to gauge the underlying earnings power right now, that 4.1% operating margin is probably a more realistic, albeit less flattering, picture before the AI revenue really kicks in.
Got it. So don't get too excited about that high net margin figure just yet. And what about cash flow, given the massive investment?
As you'd expect, free cash flow, FCF, is negative, and that negative FCF is accelerating. It hit negative $316.4 million in FY 2025.
So they're burning cash quite significantly.
They are, which again is typical for a company in this hypergrowth heavy CapEx phase. But it does mean they are reliant on external capital debt or equity markets to fund that growth. That's a risk factor.
But are they stable in the short term? Can they handle their immediate bills?
On that front, they look very strong, actually. They have an exceptionally high current ratio of 4.29.
Meaning they have over 4 times the liquid assets needed to cover their short-term liabilities.
Exactly. So while they're burning cash on growth, they have a very healthy cushion for near-term operational needs and obligations. That provides a good safety buffer.
Okay, so putting it all together, the explosive growth, the margin weirdness, the cash burn, but strong short-term position. How does this translate into valuation? That PE of 154.
Yeah, that PE tells you everything about market expectation. It's extremely high. The market is clearly not valuing IREN as just a Bitcoin miner anymore. Miners like Riot or Mirai trade at much lower multiples.
So it's being valued as a high-growth AI infrastructure stock.
Absolutely. It's getting a significant premium based on the potential of that AI cloud business. Now compare that to our discounted cash flow, our DCF model.
Which tries to calculate intrinsic value based on future cash flows.
Right. And even being quite aggressive in our assumptions, projecting high near-term growth of 63% per year for 3 years, assuming SCF margins eventually expand to a healthy 20%, and using a high discount rate of 12% to account for all the volatility and execution risk.
Even with those optimistic inputs.
Our model lands the intrinsic value somewhere in the range of $40 to $65 per share.
So with the stock at $53.50, it's right smack in the middle of our calculated range, even using pretty bullish assumptions.
Precisely. It suggests that while maybe not outrageously overvalued according to a DCF that assumes they succeed, the current price leaves very little room for error. The market is pricing in not just success, but near-perfect execution of that AI strategy.
Chapter 4. Market sentiment.
How's the broader market viewing this?
Well, Wall Street analysts seem cautiously optimistic overall. The consensus rating is around a moderate buy or buy, but underneath that consensus, there's a huge divergence of opinion.
You see that in the price targets, right?
Exactly. The spread is massive, reflecting just how much uncertainty there is about whether they can pull off this AI transition. You've got JP Morgan on the low end with a $24 target, citing valuation concerns.
$24. That's less than half the current price.
Ah. And then on the high end, you have Macquarie at $86, really buying into the long-term value of those power assets and the AI potential.
That kind of 4x difference between the high and low targets really highlights the battleground IREN has become. Bulls see a transformative infrastructure play. Bears see a massively overhyped miner.
And that conflict is really visible in the short interest figures.
Which is quite high, aren't they?
Significantly elevated. 14.48% of the public float was short as of the source date. That's over 35 million shares betting against the company.
So a substantial portion of the market is actively betting that the AI story is overblown and the valuation is unsustainable. That's a major bearish signal, obviously.
But it also creates another dynamic, doesn't it?
It does. That large short position means there's fuel for a potential short squeeze. If IREN delivers strong positive news, say, confirms major AI contracts, or beats expectations significantly, those short sellers rushing to cover their positions could rapidly drive the price even higher.
So high risk, but also potential for amplified upside on good news. Technically, how was the stock trading?
At the time of the data, the momentum was clearly bullish. The stock was trading well above both its 50-day moving average, which was around $39, and its 200-day moving average, down near $21. So technically, the trend was strongly upward.
Chapter 5. Ownership structure.
Who actually owns the stock?
It seems like the institutions are buying into the story, despite the volatility. They hold a majority stake. The sources range from 41% up to nearly 60%.
That's significant. Having major institutional players involved suggests that, sophisticated investors see long-term potential here. It provides a certain validation.
Yeah, the sources list names like BIT Capital, Jane Street, Citadel among the top holders. These aren't small players.
No, definitely not. And what about insiders? We talked about the CEO selling, but what's the overall picture?
Insider ownership remains quite high overall, around 11.1%, and that's driven primarily by those large holdings of the co-CEOs, the Roberts brothers.
Okay, so even with those recent sales, their skin is still very much in the game. That strong insider ownership does help align management's interests with shareholder outcomes.
Chapter 6, Risk Assessment.
All right, let's try to summarize the key risks and opportunities. Maybe using a quick SWOT framework: strengths, weaknesses, opportunities, threats.
Good idea. Let's start with the internal strengths. What are IREN's core competitive advantages?
I think it boils down to three main things we've discussed. One, vertical integration controlling the whole chain gives them efficiency and control. Two, the low-cost renewable power that's arguably their most durable cost advantage. And three, the strong balance sheet, specifically that high current ratio of 4.29, giving them short-term stability.
Okay, and the internal weaknesses. The constraints they face.
Two big ones stand out. First, the reliance on external capital because of that ongoing negative free cash flow needed to fund growth. They need the markets to stay open and favorable. Second, the consequence of raising capital, significant shareholder dilution. Shares outstanding grew almost 45% in just 1 year. Existing shareholders are seeing their slice of the pie shrink.
All right, now the external factors.
Yeah.
Threats.
Well, the obvious ones are still there. Bitcoin price volatility still impacts a big chunk of their revenue base. Regulatory headwinds are always a background concern, especially around grid access for crypto or energy-intensive industries.
And the source material mentioned a specific geopolitical threat, too.
Yes, the risk of potential U.S.-imposed tariffs on imported computing hardware, think ASICs for mining, or, crucially now, those expensive NVIDIA GPUs for AI. If those components get significantly more expensive due to tariffs, it would directly hit their CapEx budgets and potentially slow down that critical AI deployment timeline.
That could definitely impact their ability to hit those aggressive targets. So, balancing all that, what's the overarching opportunity?
The opportunity remains massive. It's becoming that premier neocloud provider. They seem perfectly positioned, if they execute, to leverage those unique power assets to meet the absolutely explosive demand for specialized AI compute power. They have the land, the power, the know-how.
Chapter 7, Conclusion.
Let's try and pull this all together.
Okay, so synthesizing everything we've discussed, what's the core bull case for IREN right now?
The bull case really centers on IREN being a unique, essential infrastructure play for the defining technologies of our time, AI and Bitcoin. Their 2.91 gigawatt power bank is the crown jewel, a scarce, incredibly valuable asset, providing a long-term competitive advantage, especially as it's green power. Add to that a management team that has proven they can navigate crises and make bold strategic pivots.
It's a bet on infrastructure and execution.
Exactly. On the flip side, the bear case.
It's almost entirely about valuation and the immense pressure that puts on execution.
Right. The valuation, that PE over 150, is stretched, to put it mildly. It prices in years of flawless execution and assumes this AI transition goes off without a hitch. They're still burning through cash, negative FCF, reliant on capital markets. Any stumble delays in AI contracts, cost overruns, regulatory hurdles, those potential tariffs could seriously undermine the narrative and the stock price. And that high short interest shows a lot of people are betting exactly on that stumble.
So we land back where we started almost. The current price, $53.50, sits right in the middle of our own DCF valuation range of $40 to $65.
Which makes the investment decision incredibly nuanced right now. It's not obviously cheap. It's not perhaps outrageously expensive if you believe the most optimistic projections. It really boils down to a judgment call.
A judgment call on management's ability to deliver on the extremely high expectations embedded in that stock price. Can the Roberts brothers and their team actually build out this massive AI infrastructure on time, on budget, and secure the high-value contracts needed to justify the premium?
That's the multi-billion-dollar question. And it leads to maybe a final provocative thought for you, the listener, to mull over.
Go on.
Forget Bitcoin prices. Forget GPU shipments for just a second. The source material rightly calls power the new oil for data centers. Think about the intrinsic strategic value of IREN's secured low-cost, green 2,910 megawatt power bank on its own. In a future world likely defined by energy constraints and soaring demand for computation, what is that guaranteed block of power actually worth, regardless of whether it runs miners or AI servers today? Could that asset alone justify the valuation, or even more?
Something to think about indeed. The raw power as the ultimate asset.
And before you make any decisions based on that thought, the necessary disclaimer. This analysis was generated by an AI system. It's for educational purposes only. It is absolutely not financial advice. Please always do your own thorough research or consult with a qualified financial professional before making any investment decisions.
Sound advice. And if you found this deep dive valuable, remember to join us at Stock Analytics AI. For €4.99 a month, you unlock our entire library. 500 S&P 500 deep dives are already there.
And the NASDAQ 100 analysis is coming up next, just for members. Plus, you get to request deep dives on stocks you're interested in. Just drop the ticker in the comments section.
Thanks for tuning in to the deep dive. We'll catch you on the next one.